Thank you for joining us for another episode of Focus on Alternatives, hosted by ADISA, the Alternative and Direct Investment Securities Association. I'm Damon Elder, publisher of the DIWire.com, and I'm joined today by Daniel Oschin, who's the Chief Strategy Officer with Shopoff Realty Investments. Thanks for joining us, Daniel.
Thanks for having me.
Today we're going to talk about what is very rare, a turbulent economic time in the United States with rising interest rates, high inflation, something we haven't seen since the late 70s, early 80s. You're a real estate guy. Cheap money is good for real estate. Low inflation is good for real estate. What's going on?
Well, first of all, I don't know that they're always good for real estate, because one of the things that comes with low interest rates is typically higher prices. And as people get set in those, when they try to do something with those assets down the road, it becomes more complicated. I think for a long time our interest rates have been far too low for the real estate industry in general. You could argue it worked out well for a period of time. Right now, I mean, as everybody knows, interest rates are rising as the Fed is raising rates to try to offset inflation. Inflation is high relative to US standards, and we're trying to slow that down. For real estate, inflation is actually primarily a big positive. In some cases, you can say, well, cost of wood or other things cost more, so everything costs more, but rents are rising along with everything else. The hedge that real estate provides is typically that inflation, whatever inflation is raising the rate you can charge for rent, whether that's multifamily or whatever it is, and that as those rates go up, revenues rise, and on a cap rate basis, typically the value of the real estate is rising with it. When you have rising interest rates, even though theoretically, economically, economists would tell you that rising rates don't necessarily mean rising cap rates. I think anybody in real estate would tell you they do go along with each other. There are some variations in there. For instance, as I said, with rental rates rising, there isn't the same cap rate decompression in many asset classes as there could be with rising interest rates, but you're still seeing the effect on cap rates. So right now you have rising interest rates affecting the ability to transact, decreasing prices to some degree, but generally in most asset classes offset by either current rental rates or the prospect for what people think will be rising rates, particularly in multifamily and industrial.
Okay. So are these rates, obviously we've seen the Fed consistently now over the last several meetings take recent historically, large jumps in interest rates. How, from just speaking about interest rates, how is that impacting, in general, the real estate community?
Well, the biggest effect is the speed with which these rates increases have been made, which is unprecedented from anything I've ever seen or know about. It's rising so fast, and there's so much uncertainty that pretty much the lending market is seized. There's not that there's no lending, but it's gotten complicated, much harder. A lot of lenders are out of the market. When they are lending, the spreads are high. And so with difficulty getting financing and a lot of other unknowns, most sellers are not selling. If you don't have to sell, why would you sell into a market where you're likely going to sell for less? Most sellers are just going to wait this out. There's an expectation that rates will taper off as inflation gets under control and then eventually probably decrease. I think most people I've talked to think that there's going to be an arc with a decrease in the not too distant future, whether that's a year or 2 years or 3 years. It's not like it's 20 years. We may not see the rates we saw, in the last, say, 5 or 10 years.
Which were artificially low.
Incredibly low, but arguably also high relative to the rest of the world. You had places where there was negative interest rates. So part of what's going to affect the ability to manage the lending environment is going to be global economics, but within domestic economics, I think we're probably going to see some tapering of interest rates fairly soon, and then some decrease happening down the road as inflation gets under control. In the meantime, most sellers are waiting to sell to get the most out of their real estate unless they have to deal with it now. What it's really affecting at the moment is people have to refinance in this environment, and that's just the luck of the draw. However long your loan was, if it's coming due now, what do you do? If you're not over leveraged, you're probably okay. It's the people at high leverage deals or high leverage relative to the real value of their real estate that are having a difficulty refinancing in this market and may face the requirement to sell.
So how does this turbulent, volatile time, this, again, some volatility and things happening that we haven't seen in decades, how does it affect the underwriting for an asset or assets, or how you look at your portfolio or manage it? How does it change things?
It's actually easier now. The difficulty was for the last 12, 15 years, however long you want to go back in time, since the great financial crisis, everybody's been waiting for interest rates to rise. And we had a little blip a couple times where they rose and then they dropped back down. I refinanced an apartment building, or actually 3 apartment buildings, at a rate that at the time, a few months later, seemed crazy high, now seems very low. But everybody
go back to the 70s, you're talking 18%, right?
Of course. And even in the 90s, when we were selling apartment buildings, I worked at Marcus and Millichap, and they were 7 and 8% interest rates were normal. But we've been waiting for rates to go up. So most firms like ours have been underwriting, assuming a lot of their rates were going to go up. I don't know, that maybe as high as they are now, but an expectation that rates were rising. But it was really unknown. Today, you know where rates are and where they're probably going to end up, at least within some range. It's actually a little easier to do the underwriting. The complexity, again, is being able to even source the financing to make that underwriting real.
Okay. So what's the outlook then? What do you see? How are things going to shake out in the mid to long term? What should advisors be telling their clients?
Well, with any kind of holding power, I think people are mostly okay. If you're buying today, and you're buying in a higher interest rate environment and theoretically a lower price environment, you should be fine in the long run. If you have financing that makes sense, and if your underwriting is real for the type of asset, and that's a really important thing because there's this expectation of incredible rental growth across a pretty broad spectrum of asset classes that may or may not turn out to be as real as people hope it is.
Yeah, at some point, rents can't continue to rise the way they have been, right? Or
Well,
can they?
Can't is a tough word, but I think it's unlikely. So for instance, we have an industrial property where the rents are almost double, or actually are double, of what they were underwritten at 2 years ago. When you have a 100% increase in rents in 2 years, so call it 50% a year, that's theoretically unsustainable. I would say likely unsustainable. There's no such thing as for sure, but yeah, I would say rental growth is going to be hard at those levels. And same with apartments. Rental rates are rising, particularly now that people can't afford to get into a home because of the interest rates to buy one. They're renting more. Rental prices are going to be pushed up a little bit. And I think you're going to see a decrease in construction because construction financing is harder to get. Over time, that market's going to get even tighter. You're probably still going to see a lot of rental increases, but maybe in the long run, maybe not as much as we have seen. So there's a lot of kind of who knows happening in the market. What I would say, for people who are thinking about investing, there's some just basic logic. Right now, interest rates are higher, pricing should be lower. There isn't a lot of velocity of sales. Like I said, most sellers are not selling. So the idea that there's going to be these great discounts is, and there will be some, if you're very lucky and know how to negotiate and you're in the right place. But I don't think the market's going on a fire sale. And I think it will resolve itself through stability in interest rates and inflation long before people are exiting out of real estate en masse. So there will be some opportunities and we should be looking for those, but proper underwriting is the key, because even for the assets we bought before the interest rate rise, and even though we had some underwriting that offset some of that, those assets are doing fine because rental rates have risen so much and other values have increased so much that the value of those assets are essentially similar. Now there is some price changes going on, but all things being equal, it hasn't had a substantial effect on existing legacy assets. We are buying some things cheaper. So I would say now is a very good time to buy, but it's also not a time to panic. And I have yet to see these miraculous opportunities materialize.
Well, and so that's the key word, right? Opportunity. There's always a flip side, right? People think we're going into this recession. Certainly can't be anywhere near what we saw in 08 and 09. But we're going into a downturn. What are the opportunities that arise from a recession for a real estate investor?
Well, the theory is that you're buying at a better price, right? All things being equal. But I would argue again, the question of better pricing, just because something's cheaper than it was yesterday doesn't mean that it's worth more in the long run. There may be things that affect it in the long run that are keeping that price down. So it depends what you're buying and what the prospect is for real growth, and having really realistic underwriting that doesn't hope too much for the future to get better. You also keep in mind, I mean, and this was true for almost every cycle, interest rates today seem high because they're higher than what they were. They may get much higher than this, and they may sustain being higher for a long period of time. I don't think so, but maybe. So you have to accept that that's a possibility. You have to accept that rental rates may not rise as much as you hoped. There may be other issues with all kinds of things, population shifts and declining populations in a lot of different markets and other things that will affect real estate. So it's all in the underwriting and being conservative about it. But when there is volatility, when there is chaos in the market, that is typically the best opportunities to buy for the right companies.
So Daniel, as we move into the future, what are some of the key asset classes you're looking at? What do you think are going to provide the best opportunity moving forward?
Well, the ones that everybody was looking at today, and we are too, industrial, multifamily, seem like the obvious ones. Multifamily should have substantial rental growth. Industrial seems to be on the path for continued tightness of occupancy and rental growth that goes along with that. But then here's where contrarians come into the picture. Nobody wants to talk about retail and office. There's a lot of asset classes that are less favorable today. My bet is those are where you're going to find some of the best opportunities, because that's also going to be where it's the hardest to sell those assets, particularly if there's anything that goes back to a lender or is in a certain circumstance. So we're looking at all those asset classes. I think with office, it's going to be figuring out if there's an adaptive reuse for those office spaces, whether it's a different kind of office use or some other functionality. Same with retail. There's things that are going to change. So what you're going to do with it is a big part of it. But even keeping some retail and some office, there's going to be opportunities. The hardest place to buy is where everybody's gravitating to, whereas the theoretical best opportunities in industrial and multifamily are also the most highly priced. And so the question is, what are you getting for that money? So it's not, I think there's opportunity everywhere. It's about finding that opportunity and then figuring out how to make something out of that opportunity that others don't see. And that's where certain companies really shine.
Okay. So big picture, to wrap it up. What are we looking at? How long is this downturn going to persist? When will interest rates stabilize? When will inflation be tamed? Give me your thoughts, Daniel.
I'll do my Karnak
Yes.
impersonation.
Yeah, please, no impersonations.
First answer is who knows, right? I would tell you that all things being equal, I think inflation will be under control fairly soon. Famous last words, but I do think 6 months, 12 months from now, you're going to start to see, well, inflation isn't what it was. It may not be completely under control, but I think the Fed is doing a very good job of putting severe brakes on the economy right now. I think there's going to be a lot of side effects of that. And I think everybody's aware, they may not be known, but I think there's going to be severe side effects. Some of those things are going to be, as the economy slows, it may slow too fast, which causes all kinds of other problems. But I don't think it's going to have a major effect on real estate in a substantial way. It will have a short-term issue with lending, with pricing, people trying to figure out where the market is. But as it stabilizes, the market will find its place. Transaction volume will reappear. I think inflation gets under control. I think the Fed will wait a period of time and then start to decrease, which they always do. Whether rates are going to go down to 4% or 2%, who really knows, right? You don't know where the market will eventually lead. But I do have an expectation that it will resolve itself sooner because they have accelerated the speed of the increases so much. I would expect the timeline to be shorter and much more severe. The outcomes of everything they're doing is going to have a more sizable impact. I don't know that it was the best way to do it, but that's the way it's being done.
Yeah, the Fed said, look, it's going to cause some pain, but they're committed, they seemingly are committed to taming the inflation bug. So I guess we'll just have to wait and see. Thank you for your insights, Daniel. Always good to talk to you. And thank you for joining us again for another episode of Focus on Alternatives. For more information on real estate investing and all types of alternative investing, visit ADISA.org. And of course, for your daily alternative investment news, visit thediyWire.com. Thanks so much.